Over the past month, whispers among crypto insiders have grown louder. Some of the most profitable traders are discreetly moving their funds off major centralized exchanges. What's behind this silent exodus? Is it fear of escalating regulation, preparation for an unexpected market crash, or a calculated move ahead of the next rally? This video uncovers the emerging motivations, wallet activity data, and potential market consequences of this strategic shift. The video is going to be interesting, so make sure to subscribe to the channel and hit the bell icon for more future updates. Let's get into the video. Escalating regulatory pressure and risk aversion. Regulatory actions are intensifying across the globe. For instance, Singapore has mandated that exchanges servicing only overseas clients must secure a difficult-to-obtain license by June 30th or cease operations. Such tightening measures compel traders to reconsider the safety of keeping assets on platforms vulnerable to government enforcement or licensing failures. Moreover, global trends in anti-money laundering and know-your-customer enforcement, especially in the EU and US, signal a push toward scrutiny and reduced anonymity. Traders, particularly those with large positions, are choosing discretion and control over exposure to regulatory risk. The security factor: not your keys, not your coins. A strong motivator remains the fundamental crypto maxim: not your keys, not your coins. Self-custody adoption surged nearly 47% in 2024, with decentralized exchange (DEX) usage hitting record levels in early 2025. On-chain data continues to illustrate the trend. Ethereum withdrawals totaling $516 million in late May, and macro-level drops in BTC and ETH held on exchanges point to a growing shift towards self-managed wallets. For elite traders, the security provided by self-custody outweighed the convenience of keeping funds on exchanges long ago. Black swan preparation and panic hedging. Behind the scenes, heightened awareness of systemic risks has prompted many to act preemptively. Following a staggering 1.5 billion Ethereum hack at Bybit, linked to the Lazarus Group, traders raised red flags about platform vulnerabilities. Exchange collapses like FTX still echo in the minds of most serious participants. In its collapse, over $20 billion in user funds were withdrawn almost instantly as markets reeled in panic. Traders are no longer waiting for drama. They're retreating quietly in anticipation of potential shocks. Long-term holding and accumulation strategy. Mass withdrawals often reflect intent to HODL rather than trade. For instance, Ethereum whales moved $49 million to a cold wallet and amassed over $300 million worth of ETH, signaling clear long-term holding strategies. Similarly, studies show that over 1.9 million BTC have been transferred to custody or whale wallets since early 2024. This behavior restricts liquidity for immediate sale and reflects confidence in future appreciation. Shifting liquidity, DEX, and DeFi take over price discovery. Decentralized platforms are capturing the limelight. Recent analytics highlight that DEX now often serve as the primary venues for price discovery, while CX are increasingly relegated to providing exit liquidity. Decentralized platforms hit record volumes in early 2025. $434 billion in spot trading and $341 billion in derivatives, and are gaining esteem among professional traders. As smart capital gravitates toward permissionless, transparent, and self-custodial markets, centralized exchanges see diminished influence. Market impact, liquidity crunch, and price dynamics. Reduced reserves on exchanges equate to real liquidity shifts. June 2025 saw trading volumes plummet across major platforms. Binance down 22%, MEXC 44%, KuCoin 42%, Upbit 39%, indicative of systemic cooling in centralized trading. Large withdrawals of stablecoins further strain on-exchange liquidity, potentially increasing price slippage and widening spreads. Yet, this pullback may also embolden bullish momentum by creating scarcity. With fewer coins available to sell immediately, market resilience and upward pressure on prices may strengthen. Quiet moves, loud implications. In silence, top traders are pivoting. Whether driven by regulatory uncertainty, threats to exchange security, accumulation strategies, or a growing comfort with DeFi, the shift is clear. Centralized exchanges are losing significant institutional trust and capital. Market structure may blur further as DEXs rise, liquidity consolidates, and long-term holding becomes more entrenched. Watch exchange inflows-outflows, self-custody adoption rates, and on-chain whale movements, because while the moves are quiet, their implications could resonate loudly in the weeks ahead. And here we have it. If you enjoyed this video, don't forget to like, share, and subscribe for more content like this. Thank you for watching. Have a wonderful day.